The fourth week of lectures was on Chapter 13, which is a cost of capital. And we covered how we calculated the weighted average cost of capital. Covered also how to do a bond valuation and a stock valuation at a high level. And then we did the concept of beta on the stock and also flotation costs and how those work. So let's start off with a general overview with the weighted average cost of capital. Okay, so the weighted average cost of capital is the hurdle rate or the discount rate used to evaluate projects. Okay, so this would be the rate that we use as a discount rate for the NPV analysis. And if you wanted to see like what is it conceptually, if I was to say to you that you took a bank loan and borrowed $100,000 to invest in the stock market and the loan cost you 4%, then logically, if I ignore taxes and everything else, you know that you need to earn more than 4% to make this profitable. If you earn 3, you're making money, but you're not, the whole venture was not profitable. You shouldn't have taken the loan. And that's essentially what it is for a corporation. How much is it costing them to get the money, and how much are their products or their projects earning? Theirs isn't quite as simple as just doing a bank loan, because they can get money from either debt or equity. Those are the two external sources of financing. And equity is common shares that are issued on the marketplace. So you take investors. And debt is either a bank loan, or for the purposes of this textbook and most finance textbooks, it could be bonds issued. Okay, so most textbooks will just focus on bonds as a public company. And that's how they borrow money, by issuing bonds. So the cost of debt is what you are paying on your bank loans and bonds. And the cost of equity is what you have as shareholders expected return. Okay, and the weighted average cost of capital is the average of these, of the external costs. So when I say external, internal would be like your net income. So if you're borrowing money or getting money outside, that's what it is. Obviously, a lower weighted average cost of capital is good. Because just like my bank loan example, if you're going to borrow money to invest in the market, the lowest rate you get is the best scenario that you would be in. The formula to calculate this, so the weighted average cost of capital, which is going to be a percentage, is equal to the percentage that you have in equity as a company times the cost of equity, plus the percentage that you have in debt times the cost of debt times 1 minus the tax rate. And I do 1 minus the tax rate because interest is deductible. Okay, so you can deduct interest for tax purposes. So what are all of these? E is the value, or I'll just say equity. I don't want to confuse the word value. This is expressed in dollar terms. D is the dollar value of debt. V is equal to equity plus debt, which is the value of the firm. RE is the cost of equity. RD is the cost of debt. And TC is the tax rate. So this will tell you how to calculate the cost of capital. Now, if we go down, let's do an example. Let's do a simple example and say you have a scenario where Company has a debt-to-equity ratio is 0.6. Okay. The cost of debt is equal to 15.15%. Cost of equity is equal to 20%. And taxes is, the tax rate is 34%. Okay. And the question is saying, what is, calculate what the weighted average cost of capital is. We're pretty much given most of the stuff here. We just have to transpose this into something else. Okay, so the WACC is equal to equity over value times the cost of equity plus debt over value times the cost of debt times 1 minus the tax rate. And we know the tax rate is 0.34. Cost of debt is 0.1515. Cost of equity is 0.2. So we don't know D and E or any of these things. So let's solve this. We don't need to know the dollar value if I know the ratio. I'm going to assume that equity is 1. So if equity is 1, therefore D has to be 0.6 for that ratio to hold. And if D is 0.6, then the value of the firm will be 1 plus 0.6, or 1.6. So if I plug these three variables into my formula, I get equity is 1 over 1.6, and debt will be 0.6 over 1.6. In that scenario, if I work this out, I will calculate that the weighted average cost of capital for this company is going to be 0.1625 or 16.25%.